Hello, and thank you for joining us today. Today, we have an exciting panel for everybody, and the goal here is to talk through really how we meet the challenge, right? Tripling clean energy investment globally. For many of us, this has been a very exciting, last 4 to 5 months as we have entered a phase where climate action is not something that we're arguing over, but now we're arguing over how we might actually achieve our climate action. And so with me today are some extraordinary panelists that are going to help me get through this really important and gnarly topic. I think that the goal of the panel is to approach this from a variety of directions. One is how we do it in the United States. The second is how we do it in OECD countries. And I'd say the third is how we do it internationally and globally. And then the last lens that we'll look at is also how we think about this across technology classes. I mean, there's certainly a lot of ideas on how to do this in electricity, but how we might want to do this in industrial and transportation and others. So please join me in welcoming our panelists. The panelists are extraordinarily accomplished and ones that I have had the good fortune to know for some time. And so I will introduce each panelist and then have them maybe talk a little bit about their backgrounds for all of your benefit. But my name is Jigar Shah. I'm the director of the Loan Programs Office and have been an entrepreneur in the clean electricity space for some time. Elise?
Hi, Elyse Allan, Dartmouth 79, Tuck 84. So great to be at this event. And I have a background that includes a long career at GE, working across all our industries. So a lot of visibility into the energy, but lots of other sectors that run on turbines and other things, as well as on the board of Brookfield Asset Management and Westinghouse.
Thank you, Elise. Sebastian?
Yes, Sebastian Deshler. I'm the General Counsel of CrossBoundary, a mission-driven investment management and investment firm, mostly focused on Africa so far. I've been working in energy and renewable energy all my professional life, first at law firms in DC, then started with Jigar at Sun Edison, helped grow the at Sun Edison's international operation as regional GC for Europe and Latin America, and then spent a couple of very interesting years as the general counsel of Terraform, the yield co that Sun Edison spun off, in which we saved from bankruptcy, or Sun Edison's bankruptcy, and then sold to Brookfield a few years ago. So also really excited to be here.
Welcome, Sebastian. Mindy?
Great, thanks, Jigar, and good to see everybody. I am not from Dartmouth. I'm an environmental lawyer by training, although I have an MBA for those of you who come out of Tuck. I've spent the last 15 or 20 years trying to integrate sustainability and climate risk into capital markets. Before that, I was a regulator at the EPA. But what I mean by integrate sustainability into capital markets, we work with about 125 publicly traded companies, 195 investors to look at climate and water and other issues as financial risks, as well as opportunities in how they run their businesses, where they invest, and so on. And the final piece, which I'll talk a bit about today, is the public sector and how we bring the right policy changes to make sure we're able to see the kind of energy future we all want to see.
Thanks, Mindy. Ray.
Good afternoon, Ray Wood. I'm a Dartmouth class of 1984, pleased to be here. I've been on Wall Street now for about 30 years, and I currently run Bank of America's global natural resource practice within the Global Corporate Investment Bank. That includes energy, mining, and power. My background is more power, utilities, unregulated power, and clean tech, and I've spent most of my career post my MBA focused on capital formation in the power sector across the wave of new technologies that have come in, and I'm very excited for the topic here today and to be with all of you.
And last but not least, Daniel.
Thanks, Jigar, and congratulations for the Irving for this inaugural event. It's really impressive. I'm sure we all wish we could be up there in person, but this is equally as good. I'm Dan Revers, founder of ArcLight Capital. I have 30 years of energy experience, the last 21 at ArcLight, which is a private investment firm investing broadly throughout the entire energy value chain, as we say, from the wellhead to the wall socket over those 20 years. I've been investing in renewable power since 2000, did some of the very first large-scale wind farms in the US, and have made a pivot over the last 2 years into this transition, which is a really interesting area that a lot of investors are interested. There's a lot of really great companies. So it's been a long time coming, but it's real.
Thank you so much. So I guess where I'd like to start is just setting the table. So when we talk about tripling investment to 2.3 trillion annually, by definition, the tripling would be, something on the order of 8 times 3. So, roughly $800 billion today being spent globally, and roughly 2.3 to 2.4 trillion needed to really meet the scale of the problem. And so I'd love to start with you, Mindy, but then I'll go to you, Ray, as well, around whether that money exists, right? Like where does it exist, and how do we define it? Because one of the things that I find that I struggle with is, we often use words like, well, we have $20 trillion in US pension funds, or we have, X trillions of dollars here and Y trillions of dollars there. And I think that we all, I think, are smart enough to know that not all that money is available to be put into exactly these infrastructure projects. And so, what is the universe in your mind, Mindy, of money that's available, and how hard is it really to attract those additional investment dollars to go from 800 billion to 2.3 trillion?
Right. So number one, I think it can be done. It is an extraordinary amount of money. Number two, it will be a combination of public and private money for sure. It's not just what is the cute new gadget or the right technology to invest in a particular place. The second thing I want to just look at for a second is COVID. COVID has shown us what a systemic risk to our economy is, and climate is no different. What we saw with COVID, and again, more of this public money than private money, is that trillions of dollars are being pumped into economies to deal with COVID. That's money that didn't exist. It was truly printed from around the globe in different countries, different economies. The bills look differently, but we had a $2 trillion stimulus package. We have a $2 trillion infrastructure package that you're working on, no doubt, Jigar, in your role as a senior government official. That tells me the money is there. In that instance, it's public money. But to think about ways beyond what is each of the investment firms we're working with, what are they able to do? And we work with 190 investors and so on. The first thing they're able to do is say to every company in their portfolio that they've got to be aligned with the Paris-aligned net zero or 1.5 degree future. Nobody really knows what 1.5 degree means in the real world. A few of us wonks know. And so what that means is if a company is going to say we're going to get to a 1.5 degree future or bring our emissions down to net zero, they've got to change everything in their workplace, in their supply chain, all of their energy use, all their vehicle use, everything they do, everything that goes on in their supply chain. That's where we're going to see. I think my colleagues are going to talk about other kinds of equity and where those dollars are coming from. But every publicly traded company, every medium-sized company needs to start transforming what they're doing. They need new technology, different technology. The Biden administration has said every government agency is going to use energy efficient vehicles. That's going to jumpstart investments in electric vehicles like nothing else. So it's not just, is there a good, clever technology that we could all pump money in? It's how do we transform our capital markets, our biggest players in capital, where every company changed their CapEx. Now's the time to do it, and they're starting to do it. So my answer is public and private dollars, we could get there.
Thanks, Mindy. Ray, give us more color on that. I mean, the vast majority of the people you talk to don't print their own money. But allocate money that they have. What does it really look like? Maybe just give us a sense of what it really looks like to go from $800 billion annually to $2.3 trillion annually.
All right, so we'll start with a serious answer, and then we can talk about Bitcoin later and how it's been solved.
NFTs.
Yeah. But and the merger of Bitcoin and clean tech for the mining. But taking a step back, this is a huge quantum of capital, obviously. But you look at the markets today, and they've never been more liquid in my career, which means there's this whole spectrum of demand to deploy capital, from very risky, which is pre-IPO venture money, and now with SPACs and with initial public offerings, there's public appetite to chase good returns and growth centered around this ESG story, this very disruption across e-mobility, stationary storage, solar and wind generation, energy as a service, distributed energy sources. You go through the whole litany of all of these areas, and that's true globally. It's not just a US or European phenomena. It's emboldened in Latin America, India, Asia, Australia, et cetera. So the capital formation has never been more rapid, and the markets are pricing these situations to encourage more capital being deployed faster. So that's the good news. The reality is the quantum of capital, though, is both for this risk capital to get these technologies scaled so they can be more cost effective and compete with existing fossil fuel options. And so once they're scaled, there's also an enormous point. You mentioned the pension money, whether it's sovereign wealth funds, pension funds, insurance companies, or corporates. There is a fair amount of real asset investment going on by these players who are increasingly comfortable with annuity style returns, bringing down the cost of capital. So there's very good news on both ends of the spectrum. Risk capital has never been the velocity of capital has never been faster, at least never over the last 30 years. And the low global interest rates that existed before the pandemic, but certainly have existed through the pandemic, are also attracting people to invest in these big utility scale and even behind the meter projects. So that you have to parse it. I think we need to parse it into the risk and the return appetites of the market, and we need to assess through market cycles how readily available will this capital be and what could get in the way. And the Biden's plan, the infrastructure plan, was met with a great deal of enthusiasm. If you look at some of the charging station companies that traded up, or some of the solar and wind companies that traded up, clearly that's very powerful at the margin. But the private markets are driving this, and various government incentive programs are certainly materially helpful.
That's great. And so let's break this up a little bit. I think part of what you're saying is that the $2.3 trillion is not all one type of capital. It spans many different types of capital and risks. And so, Daniel, you've been raising money in the energy sector for a very long time. And I think I'm curious, with the folks that you talk to on a regular basis, how do they see the risk reward, that's being set up by the Biden administration, governments, corporate announcements around net zero, et cetera, and then as a result, their appetite for meeting the challenge around, tripling their interest in the space. You're muted, my friend.
We really bridge the entire universe of investors, from high net worth individuals to endowments and foundations, corporate pension plans, public pension plans, sovereign wealth funds, and really every single one of those investors is seeking exposure to the transition. They all want to have some exposure to it. They're all thinking about where it fits within their organizations. And as Ray mentioned, there's a lot of different things going on here. There's a venture-oriented sort of clean tech piece of this that's very interesting, but very small dollars. So big sovereign wealth funds that have $1 trillion assets under management, that's not going to get them a lot of exposure. As you move to the other end of the continuum, which Ray also mentioned, is the SPAC craze. SPACs require very little money up front, and so people can get exposure there. But where our investors, who really are large scale, the bulk of them large scale public pension plans, sovereign wealth funds, want to be involved in the infrastructure, and they've gotten very comfortable with traditional sources of energy infrastructure investment. Pipelines, power plants, renewable power plants. They've invested tens of billions of dollars in those types of asset classes. And as they think about getting involved in the transition, they're really looking for that same risk reward paradigm, which is some security of getting their money back, a current yield, and are really willing to take a long-term view in terms of infrastructure. So to me, it's really creating the structures that are going to allow this massive amount of capital that wants to get in this industry to actually get deployed. And I think when I talk to our investors and talk about, who do you think is really good in this space, who's a leader in the transition, the answer is there just isn't any right now. There's not a single entity of scale that is really looking at this network on any kind of broad basis, and I think that's sorting itself out real time. The initial charging deals are coming to the market, the initial storage deals are coming to the market, and people are going to decide whether risk is being priced appropriately or not. But at the end of the day, no matter how dedicated you are to the transition, if you're a professional in a large private investment or an institutional investor and you lose money because you mispriced risk, you're not going to put a whole bunch more money in. And so I think it's incumbent upon policymakers, the financial players in this market, the strategics in this market to really come up with some really well-structured deals that are successful, because success breeds success. And the more successful the deals are, more people come in, it'll drive down the cost of capital. We're getting people comfortable with 10, 20-year horizons instead of 10-year horizons on their money, which is what you need to do to pay this stuff off. We're talking about trillions of dollars of capital. If you want your money back in 5 to 7 years, you're not going to get it back. So I think there's demand out there. It's just we need products.
So that's great. Elise, you really can talk about several angles to this question. So you can certainly pick and choose which angles you want to talk through, but there's two that I'll highlight for you. One is that Brookfield is clearly one of the best positioned entities in this space. I mean, they have a tremendous amount of respect from all the Canadian pensions, who happen to be just one of the most educated investors in the world on infrastructure, and therefore, they look for great managers, and Brookfield is one of the best managers in infrastructure. But separately, I think in your role at GE in Canada, one of the things that GE used to do was just sell equipment to utilities who knew how to raise money, because they had a monopoly license and they'd just raise money and they pay cash. And one of the things that I find sort of confusing is, as that transition has been difficult, where the big companies of the world, the GEs, the Siemens, the others of the world, who really just fulfilled orders for utilities who paid cash, are now getting into this new world of project finance and project development, and whether they have a proprietary ability to play. And so as we move from 800 billion to 2.3 trillion, my sense is that you need all of this. One, you need respected money managers and asset managers and asset operators like Brookfield is, but you also need respected technology providers who are not all startup companies. Some of them are heavy industrials who are providing, like 20, 30-year assets along with the service that goes with it to make sure that these assets are well maintained and providing service. I'm just curious on how you think about all of those things as we go from 800 billion to 2.3 trillion. And you're also muted, sorry.
Honestly, you think we'd all have this figured out a year later. Anyway, I guess one comment would be, we talked a lot, what's going to make this happen is when we have both the supply and the demand factors working together, right? That's what will make it commercially viable and make it work. And I think we were hearing from Mindy and the others a little bit about all the demand side with the investors and everybody else, and more and more customers. So wearing my GE hat, being interested, and utilities having customers who want off-taking. But I mean, the other issue is the supply side as well. So making sure that, if you're going in to do project development, are those costs, are those risks becoming more and more manageable? And I think we see in many cases that they are, as you get the policies in place, as you get other things occurring that everyone was mentioning, You certainly have, a much lower cost of construction happening for these major projects. You have all sorts of de-risking on the project development side that have to do like with modularization, as you would know from what happened on the solar side. And as that transforms into other types of renewables, what's happening in wind in terms of the efficiency of doing a wind development now, doing wind offshore relative to what we thought about doing offshore wind 10, 15 years ago and the way we can do it today. So again, the ability to supply is certainly increasing. And so when you look at the large capital projects, I mean, you have the demand increasing across all the ways that Dan and Ray talked about, which certainly helps because that de-risks those long-term projects, right? You have more tolerance, and we're also seeing right now a commitment on policy. I mean, the one thing we all know is that you want certainty and you want some sense that there's stabilization of policy when you're going into a major capital project. I would also comment about just briefly to tee it up is when we look globally outside of the US, this whole issue of how do you finance these major capital projects. Policy in a lot of these, emerging market countries, developing countries is such a challenge to know that you're going to have sustained energy policy during the course of a capital development. And also how you get financing. And so government programs like the EXIM, like credit financing, these things become very important when you're trying to bring these type of projects outside of the US into other markets, but also continue to learn how to do them in creative ways by going to new markets. I mean, one of the advantages when a US company can go offshore and build in other jurisdictions is you get creative, you get resourceful, you learn actually about better ways to build that project that you can then bring back home and bring down your costs. So the advantage of encouraging the technologists, if you would, the folks, that make this stuff, to have as big a market as possible becomes really important. The final comment I'd say is, we don't have to be doing a lot of new technology. We have a ton of technology today that will get us a long way to where we want to be. What we have to do is deploy that technology and really focus on deploying the technology we know. There shouldn't be a lot of technology risk in a lot of these projects. There's a lot of existing technology that we can deploy. So it's really about the policy, the regulation, a lot of the things around the project that become the issues that government and private sector can manage, less actually about the technology.
Well, you obviously.
Few thoughts.
I totally agree with you on that last point. It's certainly my calling card. I completely agree. You covered a lot there. So I think, Sebastian, as we go to you on this, you certainly can cover any part of what Elyse just teed you up on and others. But one thing I'd love for you to focus on a little bit is around the supply-demand imbalance. One of the things that I think we spend a lot of time doing in this conversation is around the quantum of capital, right? 2.3 trillion and SPACs and this and that and the other. But I think part of what you've noticed specifically is around the dearth of early stage development capital, right? And that's not just true in emerging markets, but also true even in the US and other places, depending on which sector you talk about, whether it's green hydrogen or other places. But I'm curious whether you have thoughts around, as we move from 800 billion to 2.3 trillion, it means that there needs to be a lot more projects that are ready for financing. And I think part of what you guys faced early on in your tenure at CrossBoundary is just a lack of deal flow in many of the markets that you were representing money into, right?
Yeah, no, thanks so much. And as I said, CrossBoundary is mostly focused, or has been focused mostly on Africa. We also do a lot of advisory, but on the project side, we run the largest, very small, but the largest C&I solar fund in Africa, and also together with the Shah and Rockefeller Foundations have been working on a project finance facility for mini grids and rural development. So the numbers I'm talking about are much smaller than the ones all of my friends and colleagues have been mentioning, but still, I think Africa and other emerging markets are really important in the overall big picture. And so I think we've seen more money also willing to go into these more challenging markets. So we've been able to raise money just recently after really struggling for years on it. I would really stress what Elise said about regulatory environments. And that's really the biggest challenge, I think, worldwide, and especially in our markets. So what we think is a bit of an ill-conceived notion to protect the local utility companies means that really progress is stifled. Just to give you an idea, in Africa alone, there are 7 million backup generators in sub-Saharan Africa alone. So that's about, depending how you do the math, that's about 120 coal-fired power stations, and people spend over $13 billion each year on fuel. Again, if you go to trillions, that's a small number. If you look at sub-Saharan Africa, that's a huge number. So just the opportunity to displace these gensets, Shah Foundation, and I put a little report that they put out here in the materials, they estimate that that's a $134 billion market. So that's money. But in order for that to work, you really need the regulatory environment that supports the ability to do these projects. I think the money is there. As Ray said, there is a lot of money. There is a lot of interest if you do it professional, if you do it right. We see it from the multinationals. We work a lot with AB InBev, the breweries, the mining companies. Everybody really wants to do it. But the regulatory system has been the biggest challenge for us, I think, to get there.
So just one more question for all of you, and then we'll go to the questions from the audience here. But I think the Biden administration has been really thinking through sort of environmental justice, labor unions, all these other constituents, to try to get to a much broader constituency of the American public interested in these issues. I think when you look at what the Arthur L. Irving Institute for Energy and Society brings to this conversation is really more of a holistic perspective to solving the world's energy problems, from an and society perspective, right? So, I'm curious, within your own thought processes here, because it's, going to be varied, I would say, is, what you think about I think we have some clarity around the financial solutions, but what about the political, technological, societal sort of solutions and how they interplay with each other to really have this mandate to do what we're suggesting, which is, frankly, we're asking for the mandate to rebuild the entire world, right? I mean, for lack of a better sense, it's like, replacing all the systems in buildings, replacing all of the transportation systems, replacing all of our electricity systems, right, in a way that's lower carbon or zero carbon, right? And I think it's not just technology that gets us there and financial wherewithal to be able to put that in. It's also sort of a mandate, stakeholder process, et cetera, to get there. So, Sebastian, I'll start with you on this one, and then we'll go around.
No, thanks so much. I do think that's there because it allows you to really reach several goals at the same time. I don't hear just the recent address by Biden to Congress his focus on jobs being related to that. So not taking out of the context and say we want to reshape everything and the abstract, it's going to cost a lot of money, but really stress the opportunity for that. Similarly, if you're again looking at Africa, that's where the great majority of people live that don't have access to electricity. And if you increase the percent of people with access to electricity by 1%, you also get roughly 1% additional GDP growth a year. And if in the cheapest way, I mean, that's the difference when we did our first project together in Europe, I remember we paid €3.08 per watt for a solar panel, and we flew them in from China. And that's 2008, so not that long ago, right? And so by now it's really, you can do this and you can do it cheap. And we're doing projects for mines. We're not because, yes, they want the green effect also, but they also, they do these projects because they make sense economically, and bringing that in and pushing that investment and supporting that investment. I think that's the change, and it's remarkable what we've seen in Africa in the last, or just also in the last 2 years. Simply that the mindset is changing really.
Mindy?
Sure. And Jigar, I love that you think small. That's always been a problem for you when you said we just need to change the energy system of the whole world and the infrastructure. Think big and we shall act big. So I obviously applaud that. So I want to speak to two things you said. The first thing you asked about was equity, I believe. And much of what I'm going to say, and I'll try and be brief, does run to the role of government. The fact that the Biden administration committed to ensure that disadvantaged communities receive 40% of the benefits of the clean energy transition. And yes, that has to be defined, and no, it's not easy. That is a bold move, because that is, as we are having what I would say is a radical, positive, urgent transition, we have to bring values into it. We have to make sure that the wrong communities are not all benefiting, and the communities that have been harmed the most left behind. So one is, I applaud the administration's goal. But secondly, given the magnitude, given the enormous magnitude of what you're talking about, let's just think about a little bit more how every one of us, private sector and public sector, need to think about the role of government. We need infrastructure at scale to drive this, and the $1 trillion plus that the Biden administration is focused on, which is equitable, which is about good jobs, is what we all need to support, whether or not our day job is in banking or clean technology. We need that jumpstart. I would argue we need a price on carbon. Right now, carbon pollution is priced at zero in many parts of the world. It makes it cheaper. So we need clear, honest market signals, and I think we need to price carbon. It's costing us billions of dollars a year. Let's not ignore those costs and call it externalities. We need the tax incentives that you're talking about. We have seen the wind and solar energies prosper because of that, and only government could provide that, whether it's state or federal. We need better disclosure, so we really do know the costs of acting on climate or not. And we need other things that drive technology. Fuel economy standards are going to say combustion engine vehicles are no longer viable. Electric vehicles are the only thing that makes sense. That will drive technology in ways that consumer demand may not be able to do as quickly enough. And we need clean electricity.
Not to interrupt you, Mindy, but like, just to be like deliberately provocative here. I mean, 10 years is a pretty short amount of time, 15 years, whatever it is that we're promising these days. I mean, do we need the Defense Production Act?
That's what I said. You always think small, Jigar. We do.
I mean,
we need to make changes at a pace and a scale unlike anything we've done. It can be done, but we need a partnership between the public and private sectors. And we need to lift the veil and really look at the audacious goals that we have and bring every tool of government to the table. Defense Production Act is a perfect example.
All right, Ray, you know, like as the government takes over all of Wall Street, what's your what's your take on?
The government is here to help you. So let's take a step back, because to hit these aggressive goals, we have to be cognizant of what a lot of people think about the Green New Deal and the fear and the hysteria and the misinformation and the political hyperbole that dominates our lives, or at least used to dominate our lives, and it's still out there if you have time from your Zoom calls to watch TV. So the Green New Deal is positioned by the skeptics as ill-conceived government largesse and a waste of money, because China and India are going to steal our global economy by not obeying the rules. And I may be cutting to the chase too quickly on that argument, but we want to achieve these aggressive goals, but we need bipartisan support to do that. So before we take over using the Defense Act, before we do all of these great things, we need the Senate to support that. Otherwise, it will not survive scrutiny, and it will actually backfire. And business and capital looks to sustainable support, not intermittent support. So there is fear of intermittency. There is fear of job loss. There's fear of global competitiveness. I think there is so much going on here with innovation that's already happening. that is very strong for this country, and we can use a modicum of additional steps, of which the Biden administration's infrastructure plans are part of that. And I don't believe, I think we need to get public education to the point where this fear of when the wind isn't blowing, you won't have power. You know, the storm in Texas was a tell sign, the wildfires in California, and both sides can take education from that as it being caused by climate change, but can also show how frail the grid is and what we need to do. So I think there's a lot of education. Yeah.
So let me interrupt you as well as I did Mindy and suggest that, let's take the other side of this, right? So Wall Street wants certainty. There's certainly a lot of ratcheting up of the words between China and the US. The Biden administration just completed a 100-day supply chain analysis. And, we make a lot of stuff in China that is essential to decarbonization here in the United States, right? What does Wall Street think about, onshoring a lot of that supply chain so that we're not subject to disruptions of that supply chain?
I think everyone's focused on supply chain right now. You can read through the research community. You can go out and buy a new car and find how limited the supply is and how every dealer is going to have a hard time because of the chip shortage. And then you look at the solar panel shortage, or where these solar panels are being manufactured and what kind of labor is being used. And we have there's no question that also because of COVID, we have a frail supply chain for something that's important. So yes, onboarding more manufacturing here would be phenomenal, and we've got to look at the cost benefit analysis there. I think the market, would value that government support, but it values it more if they feel like it's going to last. Often subsidized industries trade at lower valuation multiples because they're propped up from subsidies, as opposed to, but there's no question the tax credits for renewables have paid off if you look at the cost now to install versus where they were 15 years ago. So it's a juggling act for sure, a balancing act.
Daniel, so I'll go to you next. I mean, what do you think about this sort of holistic view? I mean, you have been working in communities for decades, right? And how do you bring everyone along and get them to be enthusiastic about this transition?
I mean, it's a good question, because for every new green energy job you start, you're going to end up taking away a job that's in the oil patch or a coal mine. So you've got sort of this zero-sum game to some extent. Retraining and things like that will help, but there's a reason that most of the oil and gas workers are down in the Gulf Coast. That's where the oil is. So I think that is a major issue for a lot of companies that we invest in. The people are looking at their futures and saying, what's my future as a rig operator or someone working in the midstream area. So I think that's part of the equation. The other part of the equation is money, as we talked about. But I think we always talk about investors as being institutions. They're GIC, BlackRock, but at the end of the day, they're people. And the public pension plans, the endowments are populated by people who have beliefs and ideas. And so as we look at and talk to those investors, certainly returns are important to them. They're there to get, for very important purposes, to provide pension plans to pensioners, to, grow universities and endowments. So returns are always going to be part of the equation. So there is sort of the litmus test of, is this thing going to make money? Because at the end of the day, you can't invest in money losing things forever, even if they are propped up by subsidies. Eventually those subsidies are going to go away or be diminished. So I think that's balanced off versus the stakeholders' mission. If we've had several pension plans over the last several years who did not re-up in our fund because we had exposure to oil and gas, we had exposure to fracking, and they made it a litmus test within those organizations to say, if you have exposure to that, we like you, we think you guys are good investors, and if you come out with a 100% clean product, we'd be happy to invest in that, but we don't want that exposure anymore. So there you've got a bit of a grassroots movement among people who are just pensioners, right? They work for the state or work for the city, and they're making their voices heard. And I think as that happens, we're going to go out and raise a 100% clean energy fund. That's what we're going to go do. We hear our constituents, our customers, and they want that. So I think that's both getting the capital side to raise their voices, because they have powerful voices, and then be mindful of the people who are going to be displaced, and thinking about those businesses, and you're going to need them. I mean, as much as everybody wants this to happen overnight, you know, the secret of the last 10, 15 years in terms of carbon reduction is a switch from coal-fired power to natural gas. And there's a lot of people who produce natural gas in the US. They produce it very efficiently. And those people are going to have to, you know, think about something else to do as we go to a decarbonized environment. So I think those are the things that we balance, both in terms of our investment and in terms of our investors.
Thanks, Daniel. Elise, yeah, obviously you could answer whatever you want here, but one thing I had on my mind, and you probably were in the middle of, was, you know, the Canadians have done a lot of great thinking on First Nations, for instance, and how they want to do work there. I think the United States now is trying to figure out what to do with, as Daniel suggested, you know, displaced workers in coal mining communities. There's a lot of power plant communities, frankly, that we're counting on the $5 million a year in property taxes that we're getting paid locally. And when you shut down a coal plant or a natural gas plant, those property taxes go away. You know, how does one participate as the head of GE Canada, or as someone who is as prominent as you are in these conversations, and how do you, you know, help the government navigate all this change?
Well, I think, you know, the first thing is you have to have all the parties around the table. I remember hearing George Shultz once said that, you know, anything that's really important that has to be changed, you've got to have all the players at the table, and it's going to take time. And I think both of those things matter. It doesn't move as fast as you want it to, because people come to that table with a different set of cultures and values and priorities. And so when you get into situations like that, you have to make sure that you come with respect, to listen to the different players at the table. And I believe you always can find a common ground, but it doesn't come easily. And all the players coming there have to want to find a common ground and not just be at the table. Representing a view and not coming off of it, right? It's a real negotiation that you have to want to move towards something better, towards something else, and you have to define what that is. You know, yesterday I listened to, at the conference, Senators Portman and Shaheen, and they also made, I thought, a very valid point, because they talked about how do we move forward when there's when energy in this whole area is so political and so politicized. How do we move forward? And we have to remember that when you start talking about supply chains and you start talking about bringing back certain systems, all these things are part of much bigger ecosystems. And you start pushing and pulling on these major systems, you drive cost, you drive price, and you really have to pay attention to, you know, if all of a sudden you're going to add all this cost to supply chain, well, what does the consumer end up seeing at the end of that? So what they talked about was, to some degree, also, how do you work locally? And how do you actually, as a federal government or as a large political force, enable a lot of activity at the local level? How do you pick the things where you know you can actually get it done, and then provide, you know, scalability, but also replicability? You know, sometimes if we bite off something that's too big, nobody can get their hands around it, and the costs of the program outweigh any of the benefits you might have achieved. And the time it takes, you've lost the opportunity and the public momentum. There's a tremendous public momentum right now with the Biden administration. It's a tremendous opportunity not only to leverage that in terms of enabling local activity through the states and through the municipalities, but also through foreign relations. To actually, and I thought Rob Portman gave some interesting examples that I wasn't familiar with about debt for reforestation, where, you know, they're using debt to actually, and reducing debt to enable changes in foreign government. It's the same as we talked about a little bit with the EXIM and the credit financing. But also, how do we then drive even like your loan programs down so that they're accepted at a local level, so that we can actually get it done? Because I think one of the things that we found in Canada is when we can do it in one or two places, or one or three or four communities, there's a lot of people that will help you quickly replicate it, because people have already de-risked it. So making it, and it takes away some of the politics, is what the senators were saying yesterday. So I just think that, you know, to offset a little bit what Mindy said about the thinking big, it's also, how do you take the big ideas but actually make them actionable at the local level, make them replicable because then people will adopt them, especially when there's momentum. And it's better to leverage the momentum towards your interest than to actually lose that broad-based momentum that you have both at the government and with your constituencies. That's worked for us in a number of areas in Canada.
No, I mean, I think it makes complete sense. I mean, $2.3 trillion is a large number, and it's not something that people can easily plug into. And so the question is, how do individual leaders take action and plug into that in a way that's accessible?
How do you make it bite-sized? You know, that's what the senators were talking about, you know, and also get agreement across the different constituencies to get it going and learn as you go, right? If you don't try it, you also don't learn what's not working so that you can fix it and do it again and make it replicable.
So the one other question I would ask to those who have an interest in answering it is on stranded costs, right? So, I mean, it wasn't but for, 2009 when Hillary Clinton came in as Secretary of State, that the United States government was flying around the world promoting LNG import terminals to anyone who would buy them. And many of those LNG import terminals are being completed now, right? It took a long time to get them built and permitted and constructed. And so whether it's LNG import terminals or whether it was Power Africa or whether it was other things, we certainly, as the United States government, but also lots of other countries around the world, we're promoting a lot of this infrastructure. And so, now that we're sort of saying, well, we need to move away from them by X date, right? I mean, how do you actually square that within, all these, frameworks that we have, whether it's corporate net zero, sort of commitments, or the Davos set, or the COP process that we're about to go into, and all those things. Mindy, I'll let you start there.
Well, part of it is going to be decided based on the numbers. There were many companies, and first of all, I'd say about a dozen of the leading electric utility companies have committed to getting to net zero by 2030. They are changing the electricity, the energy they are selling, how they get it, where they send it, and so on. And that's the kind of thinking that we need. Numbers matter. We've been spending $8 billion, $9 billion, $10 billion by many companies for tar sands in Canada. It is not cavalier to say, well, just stop spending it when so much of the economy is dependent on it. On the other hand, those resources are never going to be used. They're going to stay in the ground. They can't be burned and us reach a sustainable future, period. And so at some point, you do have to make decisions to leave them in the ground, but find other ways to help the economy. Very much the same as coal. If we're not having coal mining, those coal miners shouldn't be entirely responsible. We should have job training. We should change things. 3 or 4 years ago, oil companies were still drilling in the Arctic. The likelihood of getting oil out of the Arctic is a little bit like the likelihood of getting oil out of the moon these days. It's not there, it's expensive, it's cold, it's windy. The last time an oil company went in to drill in the Arctic, they wrote down $8 billion because they couldn't get oil. So there's nothing smart about losing money. It is complicated, but we should stop investing in infrastructure that's suspect. And we know what it is. We're in a world now where the data is clear. We know what creates climate change. We know the harms that will come from it. And as much as I agree with every one of my colleagues, and I do, and I think that the words and the concepts are spot on, and what Elyse just said about the need to bring people along, we also have this conflicting challenge of needing to move at a pace and scale unlike anything we've ever done. And so we've got a huge balancing act in front of us, and we've got to follow the money. In some ways, we're talking about investments. Where are things just too risky to invest in? Forget tar sands or oil sands, forget drilling in the Arctic. There are many things that just don't make sense, and we ought not to do it. And it's not about stopping 20 years from now. We've got to find a way to wind it back sooner rather than later without holding all of the workers, without putting them in harm, but rather better job training. And again, you work for the administration, Jigar, I don't, but I will say a lot of great things. The focus on jobs as it relates to infrastructure, I think is really smart. It's taking the humanity of the problem and the opportunity, as well as the economics of the problem and opportunity, and weaving them together.
No, I appreciate that. So I know we only have 4 minutes left. And so I'll just ask one short question of you, Ray, on this to end it. But I think, look, I think Mindy makes a good point. We got to stop doing more bad stuff. And so part of that bad stuff is stuff that we thought wasn't bad 5 years ago, right? Things like, natural gas pipeline, extensions to new neighborhoods. If you're a new home builder and you're building a new development of houses, right? Why would you connect it to natural gas at this point and pay the connection fees and the connection charges and all that stuff? I mean, how do you square that within the practice of, Wall Street having all sorts of companies who have all sorts of infrastructure? Forget about the stranded costs now. We're talking about incremental new investments they might be making 6 months from now.
Look, the market's absolutely focused on this. It's very hard to get pipelines approved. I'm not prepared to write off natural gas today, Jigar. Perhaps you are. That's fine. We can maybe save that for another panel. I think natural gas continues to be a bridge fuel. It's relatively clean. And with the right mix with hydrogen, we can leverage a lot of existing infrastructure to most cost effectively meet our goals and objectives. So I think everyone who invests in pipelines, ask TransCanada, ask Dominion, ask Southern Company, ask others who've had to have write-offs or had major delays. And there's no question that the cost of capital for those initiatives are more expensive than they were several years ago relative to the perceived risk. And then relative to, say, a new solar farm or a new wind farm. So there is, but the market will still make determinations as to what is necessary and what is an acceptable hurdle rate. And the market will decide which of those investments. And I think as the market absorbs that information and the cost of capital changes, that will naturally correct some of the money going into the areas that we perceive as dirty. So I don't believe a command and control from the central government is the way to allocate that, although there are certainly some situations that require a more direct input. Gas LNG, I think the natural correction will be, what is the global growth of demand for natural gas, and will more export facilities be built in the US or Mexico? How will those get financed? And what major multinationals will sign up long-term offtake arrangements to facilitate that? Because the only way these get built cost effectively is with major offtake. And so that's for very sophisticated global multinationals to determine, and they all have their ESG goals and objectives. They all have shareholders, just as Dan mentioned, his LPs and his investors. Everyone is very focused on this transition, and that information comes through, and that will naturally curtail some of the capital over time.
Well, I appreciate that. And with that, I just want to thank Dartmouth and the Arthur L. Irving Institute here for hosting us. We did not get into the vast majority of questions that were asked, and so I apologize for that. But frankly, the conversation was very engaging. And I do think that when you think about how much progress we've made just in the past 12 months, it's kind of breathtaking. Like we were arguing about whether climate change was real. Today we're arguing about how to tackle it. Certainly, Daniel was suggesting that that today, raising a fund where 10% of the money is going to go to non-acceptable assets is no longer possible. You have to offer a clean fund. I think Elise was absolutely right on in the way that she talked about how we bring people along, stakeholders, but also how to make this entire $2.3 trillion goal more digestible by all the individual decision makers. And I think Sebastian was suggesting that there's continues to be a tremendous amount of work to do. The opportunity is there, but actually getting the regulatory structures right, getting all of the certainty that global investors want to see, as well as all the projects developed, is taking more time and more effort than than I think people originally expected. And so I think the international, there needs to be more time, effort, and frankly expertise allocated to the international markets to be able to make them successful. But with that, we have a tremendous amount of optimism over here at the Department of Energy and the Biden administration about our ability to tackle this problem. And so I really want to thank everybody for their time and thank everybody for their attention, and look forward to seeing you at the rest of the conference.
Great, thank you.